some changes at Fundamental Trends that I'm going to go over real quick, and then we are going to jump into the hot topic of the day, the Federal Reserve thinking about tapering and the stock market having a hissy fit. So what is new at Fundamental Trends for those of you who ask? Did you ask? Of course you asked. Well, I just made a small change to the front page. I got rid of that scroller that was in here that was hard to use. And I just added a half a dozen free library content articles right here. And then we have a dozen members only content, and you can see which membership each one are. So if you're a member, you just click on the article you want to read, and it even prompts you as to who can get in. Then over at the chat board, we have added Scott Henderson, who is of Forex Analytics. So you know that I've done some guest spots on Forex Analytics, and Scott Henderson is one of their regular traders, and he does quite a bit of talking to Dale Pinkert, who is a big deal when it comes to trading futures, and he is working with me to help traders with some swing trades. So here's one that he's pointing out is a good entry point for ASTS Space Mobile. Looks like it's going to run into the teens somewhere, but also helping us buy the dips on certain stocks. So I know that one of the problems that people have is, oh, I missed getting in at the start of a trend. Well, this is going to help us buy the dips. So his main job, really there's a couple of main jobs. So his main jobs are, he is going to be helping me write the swing trading article every week. So Swinging for the Fences is going to have a trade that is our conviction trade of the week. We are going to be monitoring the SPACs for volume pickups because, as I've told you, I think the SPACs are going to be where a lot of the replacements for the zombies emerge in the next decade. So if we can find companies that are de-SPACed, meaning post-deal, that we like, and we can find ways to get in just as the volume is starting to pick up, meaning institutions, that's what we're going to look to do. We're going to have a section in there on buying the dip, which is what I just talked about. And then we're going to have shooting from the hip. And shooting from the hip, Scott's nickname is Shooter. So we're going to give him free reign in one section of that article every week to come up with a trade idea that's probably outside the realm of comfort for most people. But it will be a swing trade that he feels good on. And his swing trades are shorter, 1 to 2 weeks in duration. So if you're going to play along with shooting from the hip, you need to be online in the chat room pretty much every single day, because that's where the trade alerts will be. So he'll say, this is what I'm looking at, and the trade alert will show up on the chat. Now, if you are in the chats, you will get those, and you need to be in there because you're going to want to make those trades within an hour of when he does. There will be also a hedging section in Swinging for the Fences, so there'll be five different things, and they'll be short, a few hundred words each in a chart or two and some directions. We will do an interview with Scott when I get back from Las Vegas. I invited him to Las Vegas, but he couldn't make it. Otherwise, I would have interviewed him there the week that I was there. Maybe we'll do it anyway remotely. We'll see. In any case, I do think that the swing trading is what a lot of you have been asking for, and we will have that primarily at Fundamental Trends. I'll put the articles up at Margin of Safety Investing too, but I'm not sure how robust the support will be there because Scott's not in that chat room. So we'll give you the ideas, but you're pretty much on your own if you're at Margin of Safety Investing. If you really want some hand-holding, you'll need to be in the chat at Fundamental Trends. And if you want to be in both places, both sites, I'll work out some sort of a discount with you so you're not, paying through the nose. All right. The Fed. Oh my gosh, they're talking about tapering. Did anybody see that coming. No. Hey, look, if inflation is transitory and valuations are at records and the stock market is overbought and the Fed is talking about tapering and corporations that make money actually have to pay taxes soon, I can only think of one thing to be super bullish on Bitcoin, right? It's got to be it. I think that's how it goes. I have to consult with Elon. Now, speaking of Elon, here he is. This is unreal Elon Musk. Don't tell anybody that's my dog taking a dookie. Didn't want to jump in the snow. The Husky Lab. Why didn't it go in the snow? I don't get it. In any case, I have no idea who this guy is. It's my dog. All right. So if you're on Twitter, and I don't think that this guy is going to be posting very often, but maybe from Vegas sitting at a poker table, he gets a little bit rambunctious and decides to post some things here. Up to a whopping 7 followers so far. But some of the posts are pretty funny, I think. And I mean, come on. These are just 2 of the best images out there. See what he's doing there. He's looking away. He's not picking up his dog poop. That's what's going on. Dog pooping. He's not picking it up. All right. So the Fed is thinking about tapering. And what's happening today? Oh no! Oh no! Stocks are going down. Talked about this 6 weeks ago on Seeking Alpha. Got a lousy 73 comments. Why? Because people aren't looking forward. That's just the nature of the beast. 4 out of 5 people do not ask why good things happened, and they don't ask why bad things happen. When good things happen, they're smart. And when bad things happen, it's somebody else's fault. They don't look forward. They don't look back. They don't study history. None of it. So 4 out of 5 investors really are pretty crappy at it. So do you want to be in the other 1 in 5? Do you want to be in the good investors? Well, then study a little history, understand what's happened, why it's happened, how it's happened, look for similarities to today, right? History doesn't repeat, but it rhymes. And what has been the theme that I have been talking about since January, actually very late December. But since January, what have I said the next year or 2 will be like? I'm waiting. Come on, somebody say it. What have I said the next year or 2 will be like? It's going to chop. That's right. It's going to be choppy. There's going to be consolidation. Right. Growth will be slow once we get the rebound. Because we know that demographics are deflationary. And that's met by inflationary policy. So if the natural trend of the economy is to have slower growth, as far as we're concerned, forever, because of the aging of the population, and so many people already have moved into the middle class, then all we can do is fight that with policy. And long before Joe Biden, what phrase did I use over and over and over again before he was Build Back Better? What did I say that we had to do to get kind of to the plateau? What did we have to rebuild? We had to rebuild the whole damn world. So if we rebuild the world, smarter energy and smarter water and smarter agriculture, get rid of fossil fuels so that we can keep the farting cows, that'll take 20 or 30 years to do all that. And by then, we'll have landed on Mars. We'll probably have had our Star Trek moment where we have something travel at the speed of light. I'm not really sure about that one. But that was a cool movie, wasn't it? When they finally made a spaceship go the speed of light from a little camp in the middle of the woods. Because that's really likely. In any case, it's still Star Trek. So what do we have to deal with now? Well, if you haven't read this article, reread it because it's super important. We know population is aging, getting old. Look at how old the population is going to be just, right around the end of my lifetime. We'll be old. We're old. Super old, right? What's this? Gross domestic product, member states, right? China and the United States, neck and neck, European Union. So China, United States, European Union, And actually, India has jumped Japan. But look at the concentration here. And this is the one that's going to grow the fastest in the next 10 or 20 years, which is why one of the themes that I've had for you for years now is find ways to invest in India on the corrections. Right? There's a solar utility company that we've been buying recently. Why is aging in the population important? Because your peak spending is right around age 50. Travel, last biggest house, kids in high school and then going to college, then peak earning years, so you're saving up for retirement. Why? Because most people don't save until they're in their 50s. Right? They spend all their money until they're about 50. And then they're like, oh my God, I got to retire in 15 years. Better save money. Right? Then that little thing at the end of life, that's your medical bills. Harry Dent had this nailed a long time ago. Right? We had the baby boom. Essentially, a financial crisis was part of the baby bust. Now we're going to chop here. We do have a nice rally here. And I've told you, I don't know that I expect a recession in the United States in the next 3, 4, 5 years. I really don't. If they do the infrastructure bill, I think it'll be almost impossible to have a recession. So coming down, there should be something else in orange. There we go. I know there's a cult-like chant to bash the Federal Reserve, but I wonder how all these traders would have felt if the Fed hadn't bailed them out in the first place. The main problem with the central banks, and at least they finally have told the government that they have to do something, is that you can't just pour money on it forever. At some point, pouring money on things doesn't work much better. You have diminishing marginal returns, right? Remember that from Econ 101. And you have to do something with the money. Capitalism works when money is in motion. It can't just be hoarded. And that's why I keep telling you, I don't have any problems with the proposals by the Biden administration, and I have no idea if they'll go through, about making capital gains into income tax, about getting rid of 1031 exchanges that don't result in development, right? 1031 exchanges, 1035 is insurance products. 1031 exchanges have to do with real estate. You have a property, you want to get out of it, you want to swap it into another property. That part of the tax code was designed so that somebody who has developed a property can sell it, but roll all the money into a new development. And the reason why that law is there is because we need a lot of redevelopment pretty much all the time. So it's a reward for those people who will put their capital at risk, allows them to defer their gains, their capital gains taxes, and then go and develop properties. Now, that particular law has been abused as people just shuffle properties and kind of like a club. I mean, there actually is like a 1031 exchange club where people just exchange properties, no intent of developing anything, but just a way of deferring taxes. So there has to be some improvement in how 1031 exchanges work that doesn't make it less likely that we rebuild the world. In any case, the Federal Reserve under Janet Yellen hinted that the government had to have more fiscal policy. Well, now she's the Treasury Secretary, and she's saying it overtly. Chairman Powell hints at it, but he can't really say anything directly on policy. He can just say, hey, it'd be good for there to be more fiscal policy, fiscal stimulus, because we do have to use that money for something. So there's no shortage of capital in the world. There is so much cash out there sitting in big piles. That's why Elizabeth Warren wants a wealth tax. The problem with the wealth tax is unwieldy, is probably hard to enforce. If you ever taken a class on constitutional law or really any type of law, you know that a law is only as good as the enforceability. So you can say there's a law, but if there's no way to enforce it, what's the difference? So what we're about to see are some things come to a head. We're going to see whether or not we get some fiscal policy. And as far as the Fed goes, look, I've told you over and over again, there is no inflationary threat. None. Zero. Nada. They can't be controlled by relatively minor tweaks in tax and regulation policies. It just doesn't exist. Think of it this way, and I put this on one of the chat boards. I think I put it at both of them, actually. Think of this equation. Demographic deflation plus inflationary policy equals what number? Basically 0. That's right. Vince is all over it today. 0. Is it exactly 0, or is it a few points in either direction? But it'll be around 0. Hard to make it perfect. So if we know that there's deflation in the air and really disinflation, then most of the world is just low inflation. It's not actually deflation, but it's deflationary pressure that never really gets below 0 much. And then they print money and fiscal policy to the point where you get an awful lot of money on the Fed balance sheet, right? This is the repo bailout. This is the COVID bailout. But yet it still is going up. It drags the S&P 500 up with it. So what did we see when they tapered? Just about a year and a half. Stock market chopped along again, right in there. Then it took off. Started to chop here. QE went back up. The S&P 500 going sideways. Flat liquidity. And what we really know is that it's the change in liquidity that creates the change in the market. Not the thing down the road. It's when the change is occurring. That's when the market reacts. So if they're talking about tapering right now, and I think maybe they will taper this fall, although I'm in the camp, which is a very small camp, I think they should raise interest rates a quarter and not taper. That's what I think they should do. Raise interest rates a quarter point, stop paying interest on reserves from the banks, but keep buying government bonds and mortgage-backed securities. That's what I think they should do. I think that normalization, to the minimal extent that we're going to get it, should be interest rate driven, and that we should keep buying the treasuries through the Fed. Why? Because we're going to be deficit spending for the next few years. Until tax receipts go up, we have to deficit spend. And if we're going to rebuild the world, we're going to need a few $1 trillion to jolt us into it, so we can get all the capital moving again. And this is why tax policy and regulation make a difference, is because it helps create the incentives for people to move their money. When 1% of the population has about 70% of the money, which is what it is in the United States, and it's actually worse than some other places, it's actually worse in China, commies. When hoarding is encouraged by policy and the tax code, hoarding occurs. Why? Because we're people, we do stuff like that. There needs to be incentives to keep reinvesting your money into productive projects. I'll give you an example. There's a guy that in Milwaukee, his name's Mike, and he owns a company. It's a healthcare company of some sort. Sold another one. And in any case, it's not important how much he's worth because I don't really know. I'm guessing 100 million should be, if I had to guess. But he took a dump in Milwaukee, garbage dump, right? Not like my dog that Elon Musk stole. Took a garbage dump, turned it into a ski hill, and it had kind of been a ski hill, but it was a bad ski hill. Improved it, put in 6 baseball diamonds, 2 for kids, 4 for adults and teenagers. Turned that into a BMX track, which was one of the best ones in the country. Got rid of the BMX track, bought a minor league baseball team, independent league, built them a stadium. Now there's a healthcare facility there, rehab center, offices. A hotel went up that he's not a part of, but he's building a hotel. There's a senior living community down the street that he's a part of. Apartments, condos, homes. But one guy, with the incentive to rebuild his hometown, with only minor help from the city, to be honest with you. I mean, everybody thought it was a big deal. Oh, why are you giving a rich guy money? Well, the fact of the matter is he didn't have to spend his money there. he put some light pressure. He said, look, I can go to Oak Creek or I can go to somewhere else. He wanted to do it in Franklin, though. He said, give me a hand. He didn't squeeze him anywhere near as much as these multinationals squeeze states. They said, hey, help me out with infrastructure and a break on property taxes for a while I build this thing. So now this guy has really spurred a whole urban area to redevelop, suburban area to redevelop. They've been languishing literally all of our lives because we're about the same age. I think he's a few years younger than me. And this is one of these places where a 1031 exchange, if he wanted to move one of his properties so he could redevelop something else, would be good. And it's important for all of us to try to understand these things. Because when you look in the comments within the echo chamber, you see some of the dumbest goddamn things I've ever heard. I had somebody telling me that he agreed with Trump's policies on a bunch of different things. I was like, whatever. Doesn't matter if he's right or wrong. What mattered to me is that he just blindly had an opinion. He didn't have any idea what he was talking about or how to support it. And if that's the type of investor you are, you're screwed. You're in 4 out of 5 that basically suck. And you should index. That's why Warren Buffett tells people who don't really pay attention to just index. So at least then you'll be average. Because left to your own emotional devices and ignorance, you're going to get blown up. And then when you get blown up, instead of pointing the finger at that person in the mirror, it's going to be everybody else's fault. So all these things I talk about here are important. You have to have a clue as to why things happened, how they worked, how they might work when something similar happens next time. And what we're about to see is the Federal Reserve. Here you go. I lined this up for 25 minutes. What we're about to see is the Federal Reserve head fake you. They are not going to do much normalization. What we have right now is the Federal Reserve letting a little air out of the bubble, just a little bit. And what currency went up today and yesterday and Wednesday? Last 3 days, what currency has been strong? You might have some in your pocket, right? So when we take a look at currency charts, we want to start with ours. Look at what's happened here recently. And let's take a look at my big chart we've been working on for so long. Right? Told you, right around this line, it's going to jitterbug. And what's it doing? It's jitterbugging right along that line. A little higher than I thought, actually. Thought it might get down to 88. Whatever, it got down to 89 and change. Right there, 89 and change. 89 and change. Oh, maybe it stopped at 90 that time. Then last week, right, you can barely see the difference, right? It has moved up since Wednesday. Now, will the dollar keep going up? Hard to say. How long will people believe that the Federal Reserve is really going to tighten? I don't know. And how much do they tighten when they do? Not much, probably. So somebody on one of the chat boards was talking about how interest rates were going to go up for years. Okay, here's the first use of our farmers' words today. Bullshit. Pretty easy. Interest rates will only go up for a few quarters, probably. The only way interest rates go up longer than a few quarters is if the economy is really humming. We get a heck of a boom because we're rebuilding the world. Now, given that once again, the Republicans are blocking any type of real infrastructure package, right? You know, we're at least $15 to $20 trillion behind on deferred maintenance. I don't know if most people know that, but the deferred maintenance of our infrastructure is somewhere between $50 and $20 trillion behind. If we really wanted everything to be shipshape, the bridges not falling down, the ports open, the airports all working properly, water infrastructure, electric grid, it would cost between $15 and $20 trillion. Politicians have been allowing a big skim of the system for decades, for about 40 years now, by not doing infrastructure spending. Who uses infrastructure? That's for the little people. If you have a private jet, what do you need it for? So we'll get an infrastructure bill. Ain't going to be enough. So I don't think there'll be a big boom. But I don't think we're going to get a recession either. What are we going to get? So we already said it, slow growth forever. So once this rebound is over, that'll be your normalization back to the new normal, right? Where did the phrase the new normal come from? Out of the financial crisis. The new normal is still normal. Becoming the old normal. Just normal. Slow growth forever. So how do we navigate above and below the equilibrium line? There you go. Been talking about this for a while now, right? Right here, starting to turn over. And it's going to get back into this green zone somewhere. I don't know if it gets way down here. We have a giant correction. Maybe the Fed, fearing for the dollar, really does dramatically taper. I doubt it, highly doubt it. Something we have to watch for. I doubt it. We're only going to let the dollar go up a little bit. Be in that range that we've been watching for a long time. Middle upper 90s. So if the dollar gets too strong, financial crisis from one direction. If the dollar gets too weak, financial crisis from the other direction. So they're going to try to keep it in a range. And right now, talking about inflation, which is a bullshit idea, is just their way of doing their job. And what is the Federal Reserve's jobs? The Federal Reserve has two mandates. What are they? Come on. What are the two mandates of the Federal Reserve in America? That's right, maximum employment and moderate inflation. That's the official statement, right? If you dig deep down into the Federal Reserve paperwork, there's other things that you need to pay attention to at the Fed. And it's really their number one and number two jobs. What is the real number one job? Not the stated number one job or number two job, not the dual mandate. What's their real number one and number two jobs? The first and most important number one job for the Federal Reserve is to preserve the dollar as the reserve currency. Second most important job of the Federal Reserve, and cue your Warren Buffett parody here, is to protect the dollar as the reserve currency. The Federal Reserve's number one job above inflation affecting you, above your job, is making sure that the dollar stays reserve currency. And the idea that people at the Federal Reserve and in the federal government don't understand that, with the exception of the last president and his crew, that the dollar needs to remain the reserve currency of the world for a number of reasons, not only international stability, but because it is the greatest wealth generating thing in the history of mankind. The dollar has enabled you to live the way that you live. And all the shady, horrible, beautiful, wonderful things that we've done to keep the dollar the reserve currency is what it is. It's all about keeping the dollar the reserve currency, because the reserve currency is really what anoints the king. And our standard of living would be much, much lower if we had to pay much, much more for other stuff. I mean, honestly, if you think about this, since Richard Nixon, the dollar has really been the main thing on the planet, and even before that. Between the petrodollar and the deal with the Chinese to bring them into the world, right? China ended up becoming a gigantic export economy where we got a lot of our stuff. And by the way, they financed the credit card for us. So think about that. China financed our credit card to buy stuff from them. Now, that's interesting. Is that the trick that we used on much of the emerging world? And then we extorted military bases out of them and other things, resources and military bases mainly. We've never read Confessions of an Economic Hitman by John Perkins. You really should. So we got into the same type of deal with China, but in reverse. And China's thinking, well, heck, we can always get something out of the United States if they owe us too much money. No, but here's the thing. Yeah, not really. What's China going to do to us? They're going to extort a military base here? Are they going to get resources from us that we don't want to give them? All this matters for what's coming next. And what's coming next is more chop, more rotation, driven by the illusion that there's inflation. And when you have the Secretary of the Treasury telling you it's transitory, and the Federal Reserve Chairman telling you it's transitory out of one side of their mouth, then on Wednesday they say, we're going to talking about tapering because inflation. It's like me going to a poker table, stone cold sober, and deliberately slurring my words holding somebody else's empty beer. Well, look, it's drunk guy. I'm going to take his money. Not really drunk. Misdirection. Watch the movie Swordfish. John Travolta, Halle Berry. Misdirection. The market's wising up to it, because otherwise it would have really sold off. So what does that mean? If the market's getting harder to bluff, then they probably will taper. Right? It'll be the shot across the bow. Then suddenly they'll head back the other direction. Have you ever known a Federal Reserve Chairman named Powell to do that? How fast did Powell back off the tightening last time? It was 1 quarter, wasn't it? So understand the large secular trend. Large secular trend is slow growth forever. Disinflation and deflation are the biggest risks. Any little bout of inflation is probably due to an event that goes away, like a pandemic that disrupted supply chains and added more people working from home, right? People saying fiat currency inflation, fiat currency inflation. They're wrong. They've been wrong for 40 years. Peter Schiff is one of them. I responded on one of his threads on Twitter today. So let's get into some specific investments. Somebody asked me about gold this week on the chat room. What is the thesis for gold if we're not going to have inflation? Well, it's the same as it was before. Same as it was before. The supply of gold is very slow moving to the upside, but the demand for gold is rising because we like jewelry and because now there are some industrial uses because of the changes in communications and energy. Apple owns more gold than anybody in the country, other than the government, maybe some secret rich guys. And you aren't investing in gold if you're with me. You're investing in gold stocks, gold miners. Why? Because over and over again, I've told you that the gold miners spent the better part of 7 years making themselves healthier, right? This is where on Market Watch, I said gold miners were going to crash. They crashed. This is where I said start buying gold when it was $1,100 a share or an ounce. Start buying the gold miners. And the gold miners are what you should be buying on the dips. When it was up here, I said trim it, and I put that box there for you, and it hit the very top of the box. So now you're getting an opportunity to buy the gold miners again. Now, will they get all the way down here? Well, we'll ask Scott about that. I think the way this wave is shaking out, and he's a big-time Elliott wave guy that takes the Elliott wave and overlays it with a bunch of other things, is the right way to do it. Take your quantitative factors, your longer-term trends, and then you back up in the shorter trends, or however short you want to get. But the shorter you get, the less precise your analysis is going to be. Hence why on super short trades, short-term trades, on super short-term trades, you'll use trailing stops. On swing trades, you'll use trailing stops. On position trades, I generally don't. I'll just write a cover call once in a while. So this is getting a little breather here. Depending on what the Fed does next month, maybe it does get down into here. Maybe it gets into the 20s again. If it does, it'll probably exceed my 20% limit on gold miners. Why do I have a 20% limit on gold miners and gold-related stocks? Because we know that the correlation of gold miners to the S&P 500 is actually relatively similar at this point due to low interest rates as treasuries. So way back in 2007 and 8, you'd been super smart to buy treasuries when they were a couple points higher. Because when the crash came, the treasuries went up 20%, while people were losing half of their money. In this particular scenario, the treasuries, because they really don't have much to go on the downside for interest rates, you know, they're probably a break-even investment in a big correction. Yeah, and I'm not so sure I expect a big correction. I expect a lot of rotations, a lot of back and forth, a lot of arguments about value investing versus growth investing. I'll tell you, I'm firmly on the side of growth because it's been what's winning for 40 years. Pretty good trend. My whole career, growth has beaten value. Why would it change now? In particular, since the advent of software and technology the way we know it now, and communications, soon alternative energy, solar, right? Solar is actually an asset-light thing. And once it's built, it'll last for 20 years without much upkeep. So that's where the big growth and value divide is that you want to own the asset-light investments. Why? Because if they rely heavily on capital expenditures, you're subject to financing. You want companies that have growing free cash flows that don't require a lot of inputs. Small input, big increase in free cash flow. So gold miners are a little different because they're not asset light. Now they're asset lighter than they were. That's the improvement they made. Changes at the margins. Margins is where the money is made. But we're not investing in gold stocks because we think it's the best thing out there. Because in an 80-20 portfolio, 80% equities and 20% fixed income, that's the best long-term risk reward. The problem is that bonds suck right now. So the gold miners aren't a proxy for stocks. I mean, they are stocks, but it's not correlated to the S&P 500. You got a similar correlation as bonds. So what would you rather own right now, bonds or gold miners? That's where we're at. So in the 80-20 portfolio, 80% equities, 20% fixed income, we're just saying screw fixed income, give me gold miners instead. Because either they chop while they pay that little 1 or 2% dividend, which is about the same as a treasury, or they have a rally. Now, I'm pretty certain that this fund, when you take a look at the underlying holdings, is headed to 50 in the next 3 years. So would you want to have bonds that do this forever? Or would you like to still collect a similar coupon and have something that's probably going to go up 50%? And by the way, when you build your margin of safety, the thing that you build in is that I might be wrong, or you might be wrong, the world might be wrong, and that we do get inflation because the central banks go absolutely crazy. And the demographic deflation plus inflationary policy, they do too much inflationary policy. They're not really there yet, but I think that we're about where we're supposed to be. If we keep adding, then we could have a problem. Will they do that? I highly doubt it, given that they just pretended on Wednesday to be scared of inflation. We'd have to taper sooner. Does that or does that not smell of bullshit? Don't live in the echo chamber. Just like 4 out of 5 investors are bad at it, 4 out of 5 analysts are bad at it. And over 25 years, pretty clear that I'm not in that 4 out of 5. And I can go down the list of top analysts on websites like Seeking Alpha and Investor Place and everywhere else, and I can tell you their backstories. Now, I subscribe to only 2 services on Seeking Alpha, and I'm letting them both expire. But I've taken 2 or 3 ideas from them. I don't know that it's worth the price, but as you know, I have an awful lot of resources. So I do take the best ideas from all the people I find. In that regard, I'm a buy-side analyst. Now, when I do things like this, I'm a sell-side analyst, right? I'm doing the primary research. So we're doing both with this service. We got Dividend Sleuth and Dave Zanoni, right? They're both hybrids as well. They do some of their own bottom-up research, but a lot of it is top-down, looking at what other analysts have said. In any case, gold stocks on the pullback here, if you got caught without him. As they get into the lower 30s, you have to look at it, then maybe in the 20s. But I'm going to specifically ask Scott to put together a Elliott wave chart for us, because I don't know. Could it get down to 23? It's a pretty 23, 24. I've done the Elliott wave stuff too. It could. Which count is more likely, right? Because Elliott wave has multiple counts, generally 3 counts. Highly likely, possible, and could happen. That's the way I look at them. I think the most likely thing here is that it stops falling here around 32, 33, and then start to resume its work upward. Unless in July the Fed really, really shocks us and, does the double whammy on trying to scare people. So we'll see how much the Fed wants to scare people. And that's why you scale in, right, a little at a time, buy at multiple levels that are relatively further apart than what your typical martingale investor would do, right? In blackjack, people double down, double down, double down, double down every hand, thinking I'll eventually break even. The problem with that is you run out of money before you can win that bet that breaks you even. So when you scale in, use the technical levels, not just, well, it went down another 1% today, so I'll buy more. No. The first spot where this could change would be on this trend line, about 33, about 34. Then it's down here, then it's down here, then it's down here. So I make these boxes because that's roughly where the lines are that you should be thinking about buying. Now it started to break out here. The Fed head fake, so it drove it back down. The next time it gets out of this box, it probably runs. All right. Before I go through this last thing with ARK investments, and another set of examples, I did put up an article here. I'm going to do this every quarter. What are your nominations for the very short list? And we've gotten one so far. It's called Alarm Holdings. And I'm going to look into it, but actually looks like I'm going to put it on the list. So if you have companies here, read what the criteria are. Submit a post like this. None of the what about this company? What about that company? Because you'll get stronger than bullshit from me on that. The initials are FO. Have a thesis, have a reason. Let's see if we can put more companies on here. A lot of you are experts in particular industries where you see products come in. You say, wow, that's a neat product. I bet they sell a lot of that. Find out who makes it. And that's actually been a way that I've gotten several big ideas. All right. So if you have nominations, let me know. And this will go up on Fundamental Trends. I just don't know how to collect the ideas. I suppose through email. Or I might start allowing comments on the articles. Fundamental Trends. All right, ARK Investments. So I was talking about this fund way back here. Who's this Kathy Wood at ARK Investments that you're talking about? Well, she's got the right idea. That innovation and technology are going to continue to lead, and that you really want to look at the small and mid caps. Now, she did really well when there's liquidity. Why? Because liquidity allows people to speculate more. So up here, I told you to trim, and it hit right on my line there. So I'm pretty sure it's going to come back down. Put Scott on this one too. But I'm thinking a price in the 80s is where we get to on this. Over the summer, you're going to see a little bit more fear of tapering, a lot more people on vacation, people spending their Bitcoin profits, right? Because a lot of people got scared the heck out of Bitcoin. And they're like, okay, I tripled my money out of it. That's good enough. How do we determine what this fund is going to do? Well, easiest thing to do is take a look at their top 10 holdings. Tesla. Tesla is not in a good trend. It looks to me like there's another leg down. So if that's true, where does Tesla land? If I had to guess, see this plateau right here, price around 400. And if it gets down to around 400, at 10% of ARK, that would be a 30% loss. That's 3 points, right? 3 points off of the ARK, which is about $3 a share. Unity is not one of their funds. I just was looking at that. Holodoc, second biggest holding at about 6%. Again, it looks like it's about to drop down one more level. And again, it depends how much Fed fear there is. Roku, what company do we know is probably about to compete with them? It's actually two companies. One that's been competing with them is just got a little bit more serious when they bought MGM. So Roku could have quite a comeuppance here. If it breaks below this level, it's going all the way down in here. Square, who I love, but I think they may have tied their hitch just a little bit too much to Bitcoin, right? Their CEO is that guy. I think Square can come down in here. And I'll tell you what, if I can get Square in here around 150, probably going to be a buyer. I do think it's probably coming down under 200. I just don't know how far. Again, these are companies that, maybe we can have Scott take a look at. Shopify has just been a juggernaut, but the revenues and the EBIT to free cash flow are out of whack. Probably should be down around 500 or 600. With less liquidity, that could happen pretty quick. Zoom, I will tell you, Zoom we're using right now, and next quarter, after I learn how to use it, they have a little different way of doing the meetings. They actually have a webinar platform now, so that it's not so hard for me to use and keep it quiet. I actually think that Zoom is becoming one of my favorite companies. I used it way back here. I was stupid not to buy it. So I'm looking for a way to get back into this. And if I can get it in the 200s, I'm pretty sure I'm going to buy it, because I think their upside is tremendous and their pricing power is huge. Right now they're cheap. I think that they can end up being very, very profitable. And I don't know who would be interested in buying them. Maybe Amazon, but I think this is a company that could get bought as well. Philo, look at this chart, another ARK stock, almost 4% of ARK. Coinbase, interesting, right? Has corrected since it IPO'd. It looks like it's plateauing. So this one might, right? If they work their way into the crypto dollar world, they could be a big deal again. So the thesis on Coinbase, which is getting added to the VSL, isn't that they're a juggernaut just yet, right? It's not that I'm in love with Bitcoin or Ethereum or anything else. It's that in a world that needs bridges between the crypto world, whether it's crypto dollar or Bitcoin or Ethereum, into the banking world, Coinbase, PayPal, Square, they're all able to do that. So it's not necessarily important that a particular currency wins, cryptocurrency wins. It's just that cryptocurrencies need to get used. Given that we know the crypto dollar is coming, if we can bottom tick this one, I think it'll be pretty impressive. The problem, there's still plenty of room that it could come down, right? I mean, it could keep coming down. It's got a negative trend, seems to be leveling off. We'll see. You have to see where the buyers are. I mean, there's big buyers right in here. So somebody's probably accumulating this. Spotify, I think Sirius is going to be a credible competitor to them. And then Zillow. I'm not super excited about Zillow. I think the real estate ideas have opened the door to another idea that we have. So that other idea that we have in real estate, technology-driven real estate, right, is one of my favorites. And I think you should be open to going through that door, at least with a little bit of money, possibly pyramiding the position up or adding to it if it falls. All right, let's take a couple questions and then call it a day. It's 95 already here in Milwaukee. I'm going to go jump in the pool for lunch. Any questions? So there's a bunch of stock questions. We'll talk about those on Monday. Any ETF questions? We went over ARK and GDX. PBW. right? It's been flirting around in our buy zones. Looks like it has one more leg down. Fed seems to want that. Solar will double top eventually. So the question is how low can you get it? It looks like it's got one more bounce down over the next few months, right? Well, BST, which is a proxy for QQQ, right? Compare it to QQQ. Basically QQQ with a covered call overlay, right? So if you want QQQ, but you want to have some dividends flowing into your account, not really dividends, but option premiums, I think they're fairly similar, right? QQQ and BST, they're about the same. Depends on the time frame. I would think BST probably outperforms in the short term in a choppy market because they have the covered call overlay. We see it get down to here into the middle 40s, especially if it gets into the lower 40s. I think that's where, just like with QQQ, right? Same chart basically. So you'll notice I put my dates here at the end of October. Why is that? You may remember. And they could go to the end of the year. I mean, if there's a sell-off, right, then December ends up, if it's a negative year, then December will end up being negative because you have people finishing up their tax loss selling. However, if they make the tax cuts retroactive to the start of the year, probably don't get that closing selling at the end of the year. They probably roll over losses the next year, right? If they make the tax changes retroactive, nothing really changes. But why the end of October? Because the stock market tends to get more inflows starting in November, all the way through the end of January and into February, March, and early April. It's the nature of the beast. About 7 months of the year account for almost all the gains, and about 5 months of the year for all the losses. That's where sell in May and go away comes from. Now, it's turned into sell in June, avoid the swoon. But yeah, I think that these QQQ and BST, whichever one you want to use, right, they mirror each other. So this comes down to here. That would pull that down to there. You're looking at about percentage terms, 20-ish, 20 to 30% correction. Will we get that much? Again, depends on how much the Fed wants to scare us. But a 20 to 30% correction is normal, number one. Don't forget that that's normal. And in this case, would really get us back to a plateau right in here that represents, I think, legitimate support. All right. Have a good weekend. Try to stay cool if you're in a hot part of the country, which is almost everywhere right now. And I hope that you, in the last month or two, trimmed again. Because the summer's going to be choppy. Wait for really good opportunities. They're probably going to get them. The Fed has told you, essentially, what they told you this week is they want to let some air out of the bubble. All right. Have a good weekend.